Hello and welcome, folks. Hope you're all doing well. It's been a minute, but here we are with yet another interesting and quite insightful teaching on when and where to expect a trade to happen. So we have to know when and where we expect some trades to formulate. So without further ado, let's get into the charts and see how and when, and most importantly, when a setup should form. So this is gold. Here we have Wednesday's price action. I normally don't use the market replay tool, but bear with me. So we have Wednesday, Thursday, and Friday are to the right. Then now we have the previous price action to the left. So here we are having gold on Wednesday. He is right at the close of the New York session, and notice that on Wednesday we took out this low right here. So, and also we traded inside an inversion fair value gap, which we had right there. So the next thing that we could be aiming for, if we took out Tuesday's low, Monday's low, the next thing is Tuesday's high, and eventually aiming for Friday's high. So because from here you can see we took out, we had pretty much of sell side delivery, which took out sell side that was residing below Thursday's low, and we had also the Asian low being taken out during London Open. So it was quite obvious for us to anticipate for price to push to the upside, aiming for the highs. Notice that we had this high, we traded into this inefficiency. We did not take that high. We came all the way down, taking out this low. So this makes these two highs relatively equal. So that's what you could be aiming for on Thursday. Remember, here we're on Wednesday. So you aim for the previous day's high. Here on Wednesday, we traded all the way up, but did not take out this high. So price is fractal in nature. I'll teach you something today on a 1 minute chart, whereby you can see these things come into fruition more faster, because the 1 minute chart plays the kind of prints faster. So we're having this high, not taking out this high, and then we trade all the way back into the middle of this range. Now you have to understand the key points to understand while trading every single day, and the key point is marking the daily high or the daily low. So you're having the daily high right here, and you're having the daily low right there. Number two, you have to mark if for instance we are in this range, for instance, because as you can see we are trading inside this range. So you take your fib, anchor it from that low to that high. The midpoint is this. What do we have below? We are at premium, yes. What do we have below? Because what you want to see first is a measure of a manipulation during London Open, so that you can trade off of the manipulation. So we want to see price drop into the middle of the range, taking out maybe sell side that was residing below these lows, and eventually maybe trading inside of this inefficiency or this one, because it's below the midpoint, which is this here. So here we had a breaker. So for you to know all these things, you must blend in some PDRAs, you must blend in some other maybe let's say like something like an order block, blending something like a breaker block, an inversion fair value gap, a fair value gap, daily highs, daily lows, all that, you aim for that. So you have to blend in a couple of things. So here, for instance, if you were to trade Thursday, which you don't know what will happen, if you were to trade on Thursday, the most important thing was to mark the midpoint and note whatever was below the midpoint, which we had this gap right there. And also we had a breaker. You can see low, high, lower, low. We took out this low. So this one automatically becomes a breaker. So you mark that. We know the 50% of this, whatever is below that is to the discount. You mark that as well. And now you wait. Now patience here comes in. You wait for the time to come. Now the time is where the cleanest setups form. Either you aim for taking your setups at around the silver bullet window of time, or maybe the top of the hour, or maybe on the macros. So it all depends. So here we're having this as the midpoint. So you mark that. That's our midpoint, as you can see. So what else are we having? We're having a breaker right here. So we mark the breaker. You mark the up close candle because this is a bullish breaker. Like that. Also we have a gap right there. So whenever you see an overlap of two PDRs, two or more PDRs, it is a very strong confluence of price reacting off of that area. So you wait, have patience to wait until price reacts to gets to that area and then reacts off of that area. So we've marked the midpoint and we have a breaker. So these are nested. We call it a nested PDRA because we have a gap, we have a breaker, and also we have an order block right here. So we're having two order blocks right there. So this is quite enough for us to determine if price was to go all the way down, and gives us a reason for us to have an entry long, then you can capitalize on that. And then now time becomes everything that we count on. So we know that yesterday on Wednesday, which is the previous day, we took out Monday's low and Tuesday's low as well. So we had not taken any of the buy side. So we were to capitalize on aiming at the buy side because sell side has already been taken. So while we're moving to the left, we're having now Asia starting from New York close. There's an overlap maybe somehow, but we're having Asia all the way from New York close. Then we move. Notice that during here we're having now on Thursday, this Thursday, notice that we did not take out this high. Now, whenever you see such a thing happens and then price drops and we have maybe a breakout, some lows, or maybe a fair value gap, an inversion fair value gap, now it is time to mark those and extend them through the chart so that you can know when price comes all the way into that area, we know what to expect. So this is manipulating. This is what we call engineering liquidity, whereby we come close to that high, we don't take out that high, and then we aggressively move to the downside. So here we had to wait. London, most likely London gives us the high or the low of the day. So it is so simple. If London was going to give us the low of the day, New York will give us the high of the day. Probabilities are New York will give us the high of the day. So here we are having London not taking out this high. So this shows us that we are bullish but there will be a measure of manipulation in the market to trap traders to go short and trust that this is an area of support right here. So traders will go short, and then the market will reverse all the way up, taking out these highs. So we wait. As you can see, price went all the way down, traded into this key area. So we had the nested PDRAs, which is the breaker, and we had the fair value gap, which is a nested to the breaker. So, and we are below the midpoint of this range right here. So we don't expect price to come all the way to taking out this low, because we know we had already taken out sell side. The only thing that was remaining was buy side. So all our confluences align, all the stars align for us to go long, because we are trading into a breaker, we are trading into a fair value gap which is nested to the breaker, and also we are below the midpoint of this dealing range. So price traded all the way down. So this is what we call the manipulation. So you must understand the fact that we didn't get to take out this high. It was so clear that we're only going down to a discount to go up. So here we're having price was trading into that right at 715. What is 715? 715 from 7 to 10 is what we refer to as the ICT New York kill zone. So that's it. That's all you need. We have a clear target. We have a clear entry. Now you execute based off your own entry model. So some of us are aggressive. Some of us will put a limit order right there, and then now it gets triggered, and then price moves in their favor. So you execute based on what you know, but I'll teach still in this video on execution. So our execution happens on a 1 minute chart. So this is a 50-minute chart. This, you have to have the higher time frame analysis in line with your analysis on a lower time frame, maybe something like the 1 minute or something. So you have to know what does the higher time frame say about the lower time frame. So the lower time frame will always be submissive to the higher time frame, which as a trader you like that to happen, because if you have a trade that is supposed to form based off a higher time frame, it is quite simple and quite easy for it to come into reality, because the higher time frame has the upper hand in terms of trading. So we're having the 15 minute. 15 minute to me gives me all that I need. So here we traded at 7:30, which is the New York kill zone. We traded into this inefficiency, into the breaker, and now it is time. Now here time becomes the most important factor. So time separates everything else. So we're trading into such a zone, into such an area, key level, at a very key moment. So 7 to 10 is when we expect a trade to form. So the whole of London was moving down. So we had this drop being the Judas swing, as you can say. So we had it being the manipulative move. We traded into the midpoint of this dealing range, taking out these relative equal lows. And folks, I want you to note this. Whenever you see price forms a low like this, then goes all the way up, comes back down again, and then it does not take out that low. Have in mind that price will always revisit such a key area, because we know someone went long right here, but price came all the way down but did not take out that low. So we'll go up again to manipulate and make them trust that these will be, maybe it will meet their targets or something. But whenever you see such a high and a lower high, and a lower low, a low and a lower low, and a lower high, you expect price to revisit that area as well. So we had this is what we call engineering liquidity, for people to trust a certain level. So you expect price to drop, take out these lows, and move down below, and maybe having any other PDRA below the midpoint of that range. So that is what you look for in any days, whenever you're looking for a setup. So that is what we have. Price traded into that, and then look at the reaction that we had. We had that as the reaction. So we took out all the highs that we had. So this was on Wednesday. Thursday trading happened the way it happened. So what do we have here? We having this can also be a breaker right here. So you want to analyze, we are done with Thursday. Now you want to analyze Friday. What will Friday do? So on Friday, on Thursday we had this inefficiency right here. Also, we have this as a breaker. Low, high, lower low. We took out sell side. So we have a breaker in line with the fair value gap. Now watch what happens prior to London Open. So at London Open, price went all the way up, did not take out that high. Same thing that happened here. So we anticipating, yes, we took out buy side, but based on our analysis, this high should have taken out this high. So it is so simple. Now see this, we had this low, then this low came all the way down, but we did not take out that low. If we took out this low, it meant that we'll be bullish, aiming for this high or any other high that is to the left, but note that we did not take out this low. So we're only going up to go down. So during London Open, as you can see, we came all the way down to this level. Where did we come to? The midpoint of this gap. We didn't even get to the breaker itself. So we came all the way down to the midpoint. At what time? At 3:45. 2, which we have, if you understand the quarterly theory, we have the 130 being the true open. So at 130, we expect price to have, we are buying below and selling above the true open. So the true open is here. Here's the true open right there. So price traded all the way down, and notice we didn't take out this high. So it was so simple for you to know that we are going to buy off of that key area. So let's add another confluence. So you're having that high, that low, sorry, to that high. So what do we have? We traded all the way to the midpoint of this dealing range. What do we have below the midpoint? We have a gap which aligns with the midpoint of that gap, and also we have a breaker. So we're having those. So it is quite simple. We're trading into such a key area at a very at the time that we expect price to have a manipulative move, to have now the real move. So here we have price trading into the midpoint, which is this here, and also we traded into the midpoint of this gap. So it was so clean for us to anticipate for longs and aiming for this high being our first target, maybe this high or this high being the number one target. So here we had exactly that. Now during New York, we had we had news on Friday. So we anticipated, yes, we took out this high right there. We anticipate now, leave this range alone. Now take this range from this low to this high and determine where is the midpoint. The only thing you need to know, if you're we are trading into a range, you need to know where is the midpoint of that range. And when you know that, now you can capitalize on what is below. If you're above, you can capitalize on what is below the midpoint. So as a PDRA, so you're having a breaker, you're having a fair value gap, you're having an order block, anything that you can see. So here we traded all the way down, and then we had this massive move to the upside. So New York has not opened yet. Here is exactly at 6:45. So we expect around 7 to 10 for something to happen in between that. So we take our fib again, anchor it from this low to this high right there. What do we have below the midpoint? Right there. So let me delete this. So here we're having the midpoint. You can already see what price did on Friday. So we had the midpoint. Here, while we were up here, we had already taken out this high. We don't know if price will move again to the upside. So we have to look on a higher time frame to see if price had something that was to the upside that was to be traded to, any PDRA. So if we head over to the daily chart, for instance, I want to see. So we had these highs and we had this high. So if we head over even to the 1 week, to the weekly chart, we had this high right here. We had traded into the midpoint of this week. So the high was the next drawn liquidity, which we had. So 15 minutes, back to 15 minutes. Nice. So New York opened, we had these run to the upside, and then we had the manipulative move all the way down. Where to? Look closely. We had a gap right there. We had a gap right here. This is a breaker. Low, high, lower low. We took out sell side. So we're having these as a breaker. So we mark that as well. The most up close candle. We mark that like that. So we're having two PDRAs. As you can see, we had a gap right there, which is nested into the breaker, into the bullish breaker. So we had this. So it was so simple. We had this initial drop. You want to see a drop, you don't enter short right here, because yes, you can, because you have already taken out buy side right there. So you can enter short, no problem. But you must know that you're only going down to go up. So this is where you capitalize on your trades. This is the best that you can have. So we're having this all the way down, trading into a breaker, fair value gap, another fair value gap. Yes, we had this right here. But now remember, time becomes the number one factor. We're having news. So at exactly 9:45, we had this drop to the downside, taking out that low. And notice the same thing that I always tell you, this high did not take out this high. If you are really bearish, New York would have opened, traded all the way up, taking out that high so that we can sell short off of the liquidity grab that was above here. So we are having this as the manipulative move to the downside. So it is so simple. What is below the midpoint of that range? If it is a fair value gap, a breaker, an order block, anything, an inversion fair value gap, that is what you use. There's nothing wrong if you could have used this as an inversion fair value gap right here. Nothing wrong. Extend that through because it is below the midpoint. So you want to see price drop and then gives you on a lower time frame a reason for the entry. So we're going to go into the 1 minute chart. We start by Thursday's trade, and then we see how you can capitalize on the same on entries now on an entry level. Now we know where to target, we know where to, when and where the setups form. Now, how do we get into the trade? Where do we place our stops? So we head over to the 1 minute chart. Okay. So this is Thursday. Nice. So here you have in Thursday. Now I want you to see the manipulation in the 1 minute chart prior to a big move, either to a big rally to the upside or a big move to the downside. So here we are having price traded all the way down into the very zone. Remember, this is the 50% of the dealing range. We traded all the way down into the zone that we are supposed to be trading in. Now you wait. At what time was this? It was at 6:48. Now remember the top of the hour. There will be a run on liquidity around the top of the hour. Now you must understand which liquidity. The liquidity that we are talking about is this low. So at 7:13, we came close to taking out that low, but did not take out that low. I want to see the manipulation into the 1 minute chart that happens on a bigger perspective or a magnified perspective on a higher time frame. So you can always magnify that into a higher time frame and see if that is what exactly happens. It will only take longer to happen as compared to the 1 minute chart. So here we're having this low at 6:48. Then we anticipate at 7 to 10 a setup to form. So at that moment we took out this high right there. So it was so obvious that we are coming to take out this low. Now look at what happens. Price came all the way down to that low, did not take out this low, then went back up again, trading into this order block right here. We traded into that and then aggressively. Now here's the takeaway. If any one of you has watched till this far, this is the takeaway. At a very key moment and a very what can I say, the moment that we anticipate for something to happen is price will move in the opposite direction one-sidedly. Like for instance, we're having these relative equal lows, and then you see this, all these bearish candles right here. So it is quite informative to someone to know that we're only going all the way down aggressively to take out sell side that is residing below these lows. So we took out those lows right there, trading into the midpoint of that gap. Then now this is when you as a trader, after seeing this massive drop, a sudden drop, is when now you anticipate for longs, because this is only to take liquidity and then resume higher. So this is when you capitalize on your entry. So this will be a long entry after seeing such a thing. So you must wait and see during that window of time. Can I see that? Can I see a sudden drop? Can I see a sudden rally to the upside, taking out buy side? So this is what we call engineering liquidity. So unless your stop was here while you entered right here, you could have been taken out if your stop loss was below this low. So it is quite obvious. You wait for the manipulation to happen, and then now you can capitalize on the real move. So this will be a entry long. Here we had two things that were happening. We had this gap right here. We had this gap. So whenever we trade into a gap and then trade past it, it automatically becomes an inversion fair value gap, which price will always later come back to trade and then move higher. So here we had a volume imbalance right here and an inversion fair value gap right there. So your entry, either you could be entering long anywhere in here as an aggressive type of trader, entering long right here, or you wait for such a scenario to happen, for price to go all up, trade into a premium, and then comes back all the way down, because as you can see, price is fractal in nature. So if you are to trade based on premium to discount, this would have been it. So we traded all the way from this high to this low. This one becomes the premium. We went to a premium, then came all the way down to a discount. What do you have? A discount that we can capitalize on for our entries. So we have an inversion fair value gap, we have a volume imbalance. So that's all we have. Also, we having an order block right there. So there was a lot of things that you could have used as your way to enter into that position. So time is right. Price has reacted off of our key levels. We have had sell side being taken out right there. So what was remaining was buy side to be taken. Now you enter long right there, aim for maybe the previous day's high, inefficiencies, or any other PDRA that you feel like price will trade into. So that's basically it. There's nothing more, nothing less. That's it. Nothing more. So we go over to here. We had we now had Friday. Thursday. Yeah. So that was Thursday. Now we're having Friday. So we have already done the analysis on Friday, and we anticipate this is the 15-minute fair value gap. This is the midpoint of that range. So we anticipate price to drop all the way down into the level, more specifically below the midpoint of that range and something close to the midpoint of that gap. So here we had Friday being the last day of trading for that week. So on Friday during London, we had these, as you can see, we took out that high. So this is why I was saying you can trade this. It is tradable, no problem. But you should know that we have other PDIs that price might react off of and then comes and get you off guard and then you are taken out. So if you were to go short right here, this would have been your ideal exit point. So let me show you something. So here we have this high. These highs, they are quite relative. At exactly 2 right there, we had this rally to the upside. Notice what happened here. Price came all the way close to taking out that high, but did not take out that high, as you can see. Then it traded back again, down again, and then had this push. So this was to manipulate, but in your mind you should know that we are just going up to go down. So we traded into that, taking out everyone that was short prior to 2. So you must wait for time to come into play. There are certain things that you must learn to see, train your mind to see even before they happen. Right here at 201, we had this drop, taking out these lows right there. As you can see, we took out those lows. So it was so obvious that we took out these lows to go to take out these highs for us to sell short into the midpoint of that range and eventually into the fair value gap. So it is so simple. So this would have been your entry. We're having the breaker, high, low, high, high. So that's a breaker. You can capitalize on that for the same, or being aggressive above here and trading short. So that's it. So as you can see, this is at 340. We had traded to the midpoint, but not past the midpoint. So we wait, have the patience to wait. So this was at 352. As I always say, the top of the hour. The top of the hour is when you capitalize on your entries. All of your entries should be at least at the top of the hour. So, and maybe at that point or at that moment, you have been trading down. Now you anticipate for longs, and you are trading into a key higher level, higher time frame PDRA, which is maybe a favored gap, an order block, a breaker block, or any other thing. So here, as I always say, on a 1 minute chart, we have this as the manipulation. Hey, we are going higher. But in my mind, I am seeing this. We have not traded into the midpoint. We must trade at least past the midpoint of that range. So we're having this move to the upside, and then now you have the aggressive move that I always talk about. So on a 1 minute chart, on a high time frame, you'll not see what we are seeing right now. But on a lower time frame, we're going to see that exactly that, because we've marked our higher time frame PDRAs, and now we're in a lower time frame waiting for price to trade into our areas. So we're having this as the manipulation. The manipulation happens while taking out sell side below that. So we're having that, and then price came all the way down, trading into the midpoint of the dealing range, and then now we had this aggressive move to the upside at around 850s. So 350s, sorry. So that was basically it. Nothing else. You wait for that, and then you trade now the obvious. This is what we call an obvious setup. You don't miss such setups. So this is what we call an obvious setup. Wait for the manipulation, entry, stop loss below the midpoint, anywhere below the midpoint, and then now you anticipate for a run higher. So that is what we're having. So during New York, remember this is a breaker, low, high, lower, low. So you're having this as the breaker, 15-minute breaker block, and then this is what we marked as the 50% of this dealing range. So we have in premium, and then we're having discount. So price went all the way up, Notice that this high wasn't taken out by this high. Price came all the way down, did not get to the midpoint, went all the way up, did not take out that high. So if you took out these highs, if you took out those highs, it would have meant that we are bearish, but we did not. Now, what we know, if you have these highs, you see they are quite relative. These are what we call now relative equal highs. They were quite relative. So we have now the manipulation that happened. So we traded aggressively. Notice we traded into this low, quite near taking out these lows, but did not. We went back all the way, hitting the order block right there. And then now see where the manipulation happened. We had this sudden drop. Even price had the most sudden drop of the entire day. So we had this sudden drop, trading below the midpoint of this range and trading inside now the breaker. And we're also having another fair value gap right here, which got traded into right there. And this happened prior to news. News happened right here. This is where news happened. So we had this sudden move to the upside. So aiming for, of course, this size. So it was quite simple. So your entry long, stop loss below this gap, below that gap or anywhere around there, and then now anticipate for longs. And this is what happened. So you must understand to the lowest degree of what price is doing. If you learn to read the 1 minute chart, the higher time frame will react the same. Nothing will change because price is fractal. So whatever happens on a 1 minute chart will happen on a higher time frame. If a low doesn't, it will only take maybe an hour or two, or maybe days, for a certain low to be taken out. But that is what exactly happens on a lower time frame. So you can be trading higher time frame swing trades or anything else, but you know what happens on a lower time frame so that you can get in earlier. You can get into a position, into a certain position way earlier. Your stop will be very small because you're on a lower time frame. Of course, you wait for the manipulation and then that's it. You have nothing else. So for those who have listened to this far, I guess that's all you'll be needing. Listen to this video as much as you can because I've put out a lot in that video. There's nothing else you'll ever need apart from what I've just said. Look at the midpoint of any range, previous days lows and highs, and then now for the entries, what you need to see happen should happen when the time is right for entries, nothing else. So I guess I don't have anything else to add to that, unless maybe any one of you have any questions, any one of you have anything that you'd like me to explain and go in depth into. You can drop them in the comment. I have my email at the profile, so you can check it out. And then that's all folks. I don't think there is anything else, and I wish you a happy weekend, and until I talk to you next time, be safe.